2024 is an election year, and this year U.S. equity markets have mostly moved higher, at least through August. We attribute the gains to several contributing factors that include positive economic growth, lower interest rates, and artificial intelligence investment. Not driving the gains, in our view, are 2024 election expectations. Even during the brief periods of equity market declines this year, which were in mid-April and late July, the culprits were inflation fears and slowing jobs growth, not politics. We conclude that despite the 2024 election being a top political story, it's had very little impact on financial markets. But the election cycle could be later than usual this year, because only recently have both candidates been set, and with President Biden stepping aside, the U.S. will have a new president in 2025. The November 5th election now is just over 2 months away, and the volume of questions has increased as investors ask us about how the election could impact their portfolios. But I'll jump directly to the punchline first. We don't think that investors should make broad portfolio changes due to election predictions. This is for two reasons. Number one, election outcomes are unpredictable. Major legislative changes must pass through Congress before the president signs, and predicting the party composition of the House and the Senate, which happens every 2 years, is even less accurate than Oval Office forecasts. And number two, the best run companies, the true leaders with great management and competitive advantages, can optimize results across business environments and political shifts. They often become stronger in the tough times. Going back to 1945, a period of nearly 80 years, the S&P 500, looking at calendar years, has performed better on average under Democrat presidents than Republican presidents. But if you factor in Congress, adding the control of the House and the Senate to the president, the average S&P 500 annual calendar year price return is the same, 9.1%, under either Republican control or Democrat control. Going back to the 2024 election, we expect more volatility. In the lead up to Election Day, we could see markets react to unexpected surprises or shifts in polling. And this uncertainty, in our view, is unlikely to fuel large market gains, and we could see more cautious equity markets ahead. Avoid making sector bets now on election uncertainty. Even if an investor correctly predicts the election results, the market reaction could disappoint. Just look at the first Trump administration, which was 2017 to 2020. This was a pro-fossil fuels administration, but the S&P 500 energy sector was the worst performing sector over the 4-year period. But then under President Biden, certainly less friendly to fossil fuels, energy was the best performing sector for 2021 through July of this year. So what to do? Well, vote. Elections are important. But don't change how you manage your portfolio allocations based upon uncertainty. Use market strength to rebalance positions and build diversification. No matter who wins the election, there are challenges ahead in 2025, and the best companies should rise to meet those challenges. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.